Sentiment in equity markets has shifted, not least due to some of the tariff talk. Something else that has changed are the inflation indicators. Now, we've got the University of Michigan survey on long-term inflation expectations rising to the highest level in almost 3 decades. While their expectations have surged, market-based measures such as tips, break-evens have been far more stable, showing a more modest rise over the last 6 months. So historically, which of these measures on the inflation front has actually been a better guide? And maybe you can tell us a little bit about the sentiment that we are watching as well. Well, joining us here to unpack all of these different indicators and the math behind many of them, and including some of the sectors that she is favoring within the markets today, is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. How are you?
Hi, Pamela. I'm well. It's great to be back. Happy spring.
Happy spring. We're getting there. We're getting there. Absolutely. Well, great to have you with us, and we'll invite everyone to send their questions in for you for the next little while. So sentiment has shifted. We've got some dueling inflation discussions to have here. We're really in the middle of, what is this? This is a market correction. We're not there yet, but these do happen in markets, but we're all watching it pretty closely right now.
Yes, corrections are normal, and we call them normal and healthy until they actually happen when people tend to panic. So, look, I mean, to give you some stats on how common corrections are, a correction between 5 and 15% happened in 60% of the years since 1962. So this is fairly commonplace. And in fact, in 2023 and I think 2024, both saw peak to trough contractions in the S&P 500 of just over 10%. So we're not even quite there yet. So these things do happen. There is always a quote reason. The question is the reason an opportunity to position for more upside over the next 12 months, or is this a shot across the bow? And I think that's when you need to do a deep dive into the data and what it's telling you. My base case is that there's more opportunity in this correction.
Interesting. Okay, so we've heard from some market commentators saying that the tariff discussions, the actual implementation of tariffs, actually is where we are right now with some of them, is a shock to the economy. You've been talking about this sometimes, a shock to growth. There's an inflationary aspect to it all as well. Is this like a shock for an oil price to the economy? I mean, is that market commentators saying such things true? Is that about right?
I think that's the exact way to consider it. I mean, it's very dangerous to say it's different this time. In the tariff experiences we have, and granted, they're not the same magnitude, and it is different this time. Most of the time, in fact, 100% of the tariff instances we have, the CPI or any other measure of inflation has decelerated over that next 12 months. Again, there could be some noise in an individual month, but generally speaking, it acts more like a tax to the US consumer that has the potential, if large enough, to be a deflationary hit, not an inflationary one, again, over time. So I think that that's exactly the right context. So history teaches us, number one, that tariffs are more deflationary risk than an inflationary risk. And data point number two is we can start to size the shock and evaluate in a historical context. And I think we've seen shocks that tip us into recession, and they tend to be between 1 and 2.5% of GDP. We used to see these shocks a lot in oil in the 70s, 80s, even in the 90s. So we can compare it to that and talk about tariffs as a tipping point. So there's a couple of things that we learned in tariffs. One is that not all prices accelerate, so there are some offsets. There are also some offsets in currency. To give you an example, in the Mexican peso, actually the dollar appreciated versus the Mexican peso by about 25% before the tariffs of 25% were in fact initiated. So there are some offsets going on, and there could be the foreign producer that provides an offset that doesn't want to cede share. So not all of those cost increases end up on the US consumer. If we sort of take a guess, and it is a guess, and you say a third ends up on the US consumer, when we add up all the tariffs on Mexico, Canada, and China, and Canadian imports on oil being separate, if you add all of those up, it tends to be about a 35 to 45 basis point headwind to the US consumer. Remember, we have $25 trillion in income that constantly grows. Now, we have seen a headwind like that before to the US consumer. And when you go back historically, it usually comes from oil prices. When we have seen a headwind like that, it doesn't have any impact on the market. It doesn't have any impact on earnings growth, and it doesn't have any impact on GDP growth. In fact, when you do the math behind what we just saw in move in oil prices from 75 down to below 70, that's almost the exact same amount in terms of a tailwind on the other side. So that's the math behind. I'm not sure what we're seeing is large enough to be an influence on the market over the long term.
For the US consumer. So let's talk about sentiment though, because sentiment has been coming through in a number of different ways. I mean, we are watching a much more rapid rotation at this point and a change in leadership. I mean, that is what's happening along with sort of the overall market sinking.
Yes. So we have seen, so there's a short-term sentiment indicator that I like just because it's so short-term. It comes out weekly. It's the AAII, or American Association of Individual Investors survey. And it has the number of bulls or percentage of bulls, the number of bears or percentage of bears, and those that are neutral. I like to watch, you can watch the net survey. I like to watch the number of bulls. And what you see now is it's at bottom quartile levels, and there are basically no bulls left. The most interesting piece of information about that data set that goes back to 1987 is if I look at the data over the last 6 weeks, we had the biggest turn in bulls we've ever seen, from a lot of bulls to no bulls, in the quickest ratio since the Gulf War. That's the only other time that sentiment has shifted this quickly. So if you say, okay, well, starting points matter, now that there are bottom quartile bulls, statistically speaking, what's the risk reward for the market? Over the next 6 and 12 months, you have 90 and 95% odds of a market advance. It's not 100%. The only instance we saw down markets over the next 6 months and 1 year was in 2022, when the Fed was rapidly raising interest rates. So it's not a lock, right? So it's not 100% odds, but you can see the bias when you see that washout in sentiment indicators. And again, we talked a lot about how quickly sentiment resets this cycle, and it's getting more and more aggressive. So you have to be very careful and disciplined as an investor not to trade headlines.
It's so interesting because you think of all the geopolitical things that have happened and hit the markets and be priced in one way or the other since the Gulf War. I mean, that's right. And none of them have seen this level of bullish investors exit the market.
Exactly. It's the quickest it's ever been. I mean, I think that mainly the financial crisis had probably a bigger peak to trough. I don't have the data in front of me, but it took time to play out. Right? This is, everybody got to one side of the boat pretty much instantly, much like a war.
Right. Really interesting. What do you think of the so-called sort of Trump bump being gone, or at least us being back to that spot? And I guess in a way, what it sets us up for later on in the year, perhaps, or a slightly longer term. You've just given us a short-term one.
Yeah, so the indicators are interesting in the sense that, you know, Philly Fed CapEx or the small business survey, a lot of those you saw an increase in demand. There was really going to be an increase in imports ahead of the tariffs, but a lot of the employment indicators turned along with it, as did the credit hard to get for small businesses. These two things, those indicators are very sticky and very predictive, right? This wasn't around tariffs. Now, even after the rise you've seen, you would expect some mean reversion in the next couple of months. But even despite a mean reversion that usually happens 80% of the time, these are really strong indicators for coming loan growth and for coming CapEx expansion. Those two things are quite bullish for the US economy. And then there's the little twist that, as much as we are focused on tariffs right now because they are right in front of us, I think remember that the market is a discounting mechanism and tends to look far into the future. If that ends up being offset by tax cuts or a boost from deregulation, which we're really kind of proxying in that credit hard to get survey, then it might end up not being a net bad effect on the US consumer, the economy, and or on earnings growth. So it wouldn't surprise me if the market, while volatile, can look through some coming bumps in the road to the extent that tax cuts are still on track.
Okay, well, let's talk just a little bit about some of those tax cuts, because part of the tariff philosophy, it seems, out of the administration is that the tariffs will help to fund tax cuts, and at least the ones that are already established, if not more. So how necessary then is the whole tariff regime, large or small, to the offsets?
Not clear. So that actually, you should tune into Policy 30 on that. They talk a lot about that in terms of it's still not clear if that will provide an offset in reconciliation. So whether or not they will, quote, count it. So that's still being hotly debated if that's an actual offset that can be built into the bill, whether it be one bill or two bills.
Okay, policy 30, everyone should tune into that. Yeah, how
Yeah.
can we handle that? But that's talking a lot about inside Washington. Yeah, and how this is all working its way through. Let's go back to the indicators for inflation. You mentioned actually there's a deflationary feel to things. We also saw Scott Bessent saying in the last week that sort of the housing market will unfreeze, sees inflation getting back down to 2%, all with some sort of alacrity. I mean, he didn't put specific dates on it, but definitely wasn't talking about inflation.
Yeah, it's interesting when you think about all of the rhetoric from the administration in the last however many weeks that they've taken over. Instead of talking about the equity put, it's more that they focus on bond yields, don't they? That's what seems to be coming up over and over again. So it is the interesting thing. So it's funny because I get a lot of questions on stagflation and I still get them. And what's interesting is when the tariff headlines hit, what did we see? We saw a very large move down in bond yields. So I do think that that's the market telling you that this is more likely a deflationary problem than an inflationary one. I will say the good news around that, if you buy my math on it's not as big of a headwind to the US consumer to be a tipping point for a US recession, in parentheses, yet, what you can say statistically is to the extent that it's not a shock, the peak to trough contraction that we've seen in rates and oil prices tends to be a natural regulator to the consumer, to earnings growth, and the economy. So the further they go down, the more the stock market goes up in the future. So that big move in interest rates is actually bullish and stimulus, and that big move down in oil price is actually bullish and stimulus. So while we're focused on the headwinds, let's not forget about the tailwinds that keep going down to those bottom decile levels that will provide this natural regulator effect to US markets and to the overall economy.
Okay, and to which sectors? Where does this come in? Maybe we also go up and down the cap scale, but for sure to sectors that would be rate sensitive and everything else, because we're also hearing that the Fed baked into the market right now is more cuts.
Right. So let's talk about financials and consumer discretionary, which is where I think that leadership is likely to end up being in 2025. There is a hot debate internal to Fidelity on whether the market can be higher if leadership like technology falls or underperforms. I'm on the side of, look, I think technology is going to be volatile. I don't think it's going to be a particularly great sector. It's not going to be leadership that we've seen over the last 2 years, but I don't think it's going to be a particularly bad sector either. I do think that that allows the ability for the market to have different leadership. And that I think is still, even financials have acted pretty well in the downturn. Consumer discretionary, not as great, but it outperformed quite substantially into the last part of the year. So for me, when I focus on where I want to be adding, those are two sectors that interest me a lot, in part because of the stimulus we just talked about with lower interest rates, which is critical for consumer discretionary, and lower yields with still low credit spreads, which is critical for financials. Both provide a really strong value component in my work, meaning that the risk reward is positive because on indicators that have worked, they're in the bottom quartile of their valuation range since the 60s, and that has usually provided you much more upside than downside. So it's a really positive risk reward. So I think that the rotation that we saw play out into the last 6 months of last year is likely to be the leadership that emerges over the course of the next 12 months.
That is so fascinating. So take us a little bit to what's at the bottom. It's obviously not tech, is what you're saying.
No, I don't think it is technology. I mean, technology is likely to be volatile, but again, there are big components in technology like software that are in the bottom half of the valuation distribution. And that usually cushions the blow. That's not to say you're not going to have some idiosyncratic risk in individual names that everybody's focused on, but it does say when you sort of step back and look at the entire sector, I don't think it's particularly negative. I would be surprised if we end the year with technology being one of the biggest laggards. It would not surprise me at all if energy is one of the biggest laggards. I mean, what we saw was yet another, a little bit shot over the bow in terms of supply, with OPEC saying that, oh, maybe we will actually add back to production. So we'll see how that works out. But even when you look, let's forget supply for a second, let's step back and say which sector from a fundamental perspective is in the worst position. It's still energy. And it still comes back to the fact that 2022 was so strong in terms of operating margins, free cash flow, returns, that we still need to renormalize back to at least just, out of the top quartile and maybe closer to average levels before I think that you can see a resurgence in profitability. Valuation doesn't cushion the blow here historically. Energy is this sector where you tend to get trough multiples or valuations on trough earnings. So that's a real red flag to investors who say, well, it's okay if I'm a little early. If you're a little early here, you can lose on multiples and on earnings growth, which is that double whammy that no investor really wants to lose on. You like to have that blow cushioning like financials and like consumer discretionary, where we're seeing it provide some, statistically speaking, at least ballast to a positive risk reward, where you just don't see that statistical relationship in energy prices. So I do think the energy sector, I know people are talking about the rotation from growth to value. I do not think that all value is created equal here. I think it's beneficial in financials, but I still think that there's a deeply negative risk reward in energy stocks.
We are hearing a lot about value. That is perking up all over the place. Is real estate value at this point? It's also interest rate sensitive for sure.
And you can even almost call it defensive. So I present every month to the All of Asset Management with my co-author, who is a global technical strategist, Roy Justice, and he keeps telling me, as much as I think that real estate is offense, historically speaking, and glued to, usually correlated to higher markets, not lower markets, he said, yeah, but it looks like defense this cycle, Denise. It moves when utilities moves, it moves when consumer staples move. And to the extent that that is more or less right, I think that that's the one area of defense that I do think that could provide offense and defense. There's value there, there's trough fundamentals potentially there, and there is a link to interest rates. And when you go back to that credit survey, credit hard to get, right? This whole cycle has been very different. So let's evaluate the differences, because every cycle is different, in that small businesses did see a credit crunch that was recessionary-like. And that credit crunch had staying power, unlike prior recessions. We are just starting to see that credit crunch come unwound. And through expectations, to the extent that that is right, and these survey indicators are predictive, you should see loan growth accelerate, which on the 13-week rate of change, we're already starting to see. That's positive for financials, which we talked about, but it's also positive for real estate. Again, if you couple that with a lower interest rate environment, I think you got a pretty good risk reward. And yeah, it might correlate with consumer staples, but I also think it provides upside as well as maybe downside protection.
It's fascinating how real estate might be a little bit different this time coming out of, I mean, what does it normally do after you've seen interest rates come up and they then come off? This seems like it would fit with that sort of cyclical story.
It does. So more often than not, it fits with the cyclical story. I think when you correlate it to bond proxies, I think this cycle's been a little bit different. So I think that, sometimes it correlates and sometimes it doesn't, right? It certainly didn't act defensive in 2009, right? But neither did gold. So, sometimes all correlations do in fact go to one.
They do kind of break down in that sense. There's some great questions actually coming in. They certainly focus on tariffs. So let's go into a couple of them. At some point, Denise, Trump may not want to see markets continue to go down. Will that affect his position on tariffs? Yeah, what do you think?
Oh boy, I have no idea. Don't ask me what I think he will do. If anybody's ever seen the John Mulvaney skit of Horse in a Hospital, you should Google that. It's pretty funny. So I don't know. I think that people have made the argument, I will argue other people's argument, that the pain up front from tariffs is likely to be offset by the tax cuts later in the year. And I do think that investors sort of need to weigh this. So when you're adding up all the dollars under tariffs and focusing on the tariff risk, Always remember that the market's a discounting mechanism and looks to the long term and prices the cycle on mid-cycle earnings. To the extent that there are offsets and tailwinds that come 6 months from now when they get the bill together, the market might not have the volatility or downside that you expect from the shock associated with tariffs. So I don't know if that's the strategy, but you could imagine that it's the strategy to take the pain up front and to have the offsets later on.
Okay, so let's go into that. There are multiple business books on how a CEO would come in and view something as a turnaround, which may or may not be. We have no idea if that's what the president is going for, but there is that sense of taking stuff up front and then seeing it sort of. Yeah, didn't you have a name for it? The kitchen sink.
Yeah, the kitchen sinking. Yeah, you said it better than me. I think that if you were thinking of a business strategy when we think about the stock market, when the new CEO comes in, you would take everything that quarter. Like, let's kitchen sink the quarter and build from there. So that is something that we do see all the time from a stock market perspective. So that's certainly possible.
Yeah, really interesting. Within industrials, within the industry, we're talking a lot about the auto sector right now. Are you able to speak to the auto sector, or maybe more broadly, just some of the components? I didn't mean to use that word, but some of the discussion around the auto sector, which is so entwined.
Yeah, it's definitely idiosyncratic, right? So when I talk high level markets and I say that there's very little impact, there's always going to be impact on idiosyncratic companies. And the automakers are right at the forefront of this. And we just saw that with the tariff delay. The problem with the automakers is not even necessarily tariffs. It's not supply lines. For me, when I look at it, it's the deterioration in fundamentals. So from an idiosyncratic perspective, if I look at the overall auto manufacturing sector, or if I look at the auto sector, which does include components, I don't see a ton of valuation support statistically, and I don't see potentially very good fundamentals in terms of trends. So I think that there's risk there regardless. So I'd rather not play it on tariffs or no tariffs, or what's this going to mean to them. But I think that the fundamental trends are complicated and a headwind in and of themselves. That doesn't translate to the overall consumer discretionary sector. I do think that there's opportunities other places in the consumer discretionary sector, but I don't think that that's one of them.
Okay, really interesting. Another couple of questions here. So I don't know if you follow this as closely, but you were talking about oil prices, the idea of sort of an oil shock and how that may or may not compare to today. The question is, what about gas? What about
natural gas?
And natural gas?
That's actually seen a spike. So I happen to know that because I'm in New England. I mean, not that I don't watch the price, but yeah, so I have natural gas prices from a heating perspective, and I love to see my electricity bills every month. Yeah, so the translation from natural gas prices into electricity bills ends up in the CPI as an offset, very good point, to those oil prices, which obviously is powered for gasoline and heating oil. So from that perspective, there is an offset in energy prices from natural gas, but more importantly, the translation into electricity prices. So the benefits of crude oil falling or crude falling is not as much as you would see in the CPI. So that's true. I do think that from a supply perspective, it does seem like it was a fairly temporary spike, and we do see that in natural gas more than oil prices because it needs to clear. Right, there's only so much storage you can hold, which is not true for oil prices. Obviously, we had the ships offshore
holding water. Yeah,
right. So we do tend to see these very steep rises in natural gas prices that then do tend to correct.
Okay, really interesting. When you think about the R word, the recessionary word, which is getting thrown around, and we're seeing it in yields, as you mentioned earlier, is that something that we need to think differently about your top three sectors about? I mean, it seems like financials, if there was a recession, there's not a lot of escape routes for financials. If that's the case, they're exposed.
I don't know that that's true. So financials actually has offered defense in recessions when they're cheap enough. Right? It certainly wasn't the financial crisis. It certainly wasn't the pandemic. So you're not really talking about a crisis like that, but we have had recessions in the 50s and 60s and even the 70s, 1970, where financials was defense. So I'm not totally sure that financials can't offer some defensive ballast just because of where they are on valuation. But yeah, so if you go with a base case, like what's your base case entering the year? Every year, you know nothing. What's your odds of a recession? It's 15 to 20%, right? That's sort of your base case going in. And then you can sort of build up a model otherwise. If you had perfect foresight and knew that you were going to enter a recession, you're absolutely right. You usually see the cohort, and it has to be a cohort because not any individual sector tends to outperform, a cohort of consumer staples, healthcare, utilities, and I would say the old telecom services. Not every one of them outperforms every single time, but if you took a 25% basket of each of those to make it a portfolio, that portfolio has outperformed 100% of the time if you have perfect foresight. So if you're going to ask me like, Denise, but I think that we are going into a recession over the next 12 months, I will tell you statistically, that is what you're more likely to own, historically speaking. Not necessarily financials, not necessarily energy. So if that's your base case, I think that that's the ownership trends. That's not my base case. Like I said, if you go back to the shock, what is it going to take for tariffs to proxy the shocks that we have seen in the energy complex historically that's tipped us into recession? You're talking about 35% across the board tariffs on our $3.2 trillion of imports. Could we get there? Sure, I have no idea. But I do think that that's what you need to believe to sort of make that the core portion of your portfolio.
So that would be the shock if it were to get to that level. As I think you used to give us a number for oil, like oil prices would have to get to
150.
150, okay, where we could not absorb.
Right.
We could complain a lot, but we could still absorb up until that point.
Yes, and then the always issue is that's right now, right? It all has to happen at once right now to be that large of a shock because incomes grow. So to the extent that this ends up getting dragged out and it's off again, it's on again, it's delayed again, and then there's this and then that's delayed, and you sort of piecemeal it together, the longer it drags out, the more likely income grows with it, and that's still nominal income growing at, you know, a 4.5% clip, right? $25 trillion of income in the US economy, and then you need even more and more of a shock to be the tipping point.
So back to defensiveness with sectors themselves. I mean, healthcare was, I think you used to call it evergreen. You're mentioning here now that there's some different ways of looking at that, and it's not always the same way. But let's go to utilities, which have had a whole different narrative around them since AI has come to the fore over the course of the last couple of years. So healthcare and utilities kind of have new narratives around them, and just go back to whether you do or don't feel that they could be kind of defensive evergreen type.
Yeah. So I'm more worried about utilities not acting like defense just because it outperformed last year, or
It's relative. Okay.
Yes, outperformed the overall market. So on relative, depending on when you pick your timeframes, I'm not quite sure if it was for the calendar year, but that problematically put them out of any kind of valuation territory, which isn't usually predictive, but at least, you know, it gave you something in terms of support. And dividend yields versus interest rates, that's not really providing any support. So you had the outperformance, which you usually then want to sell. And I'm not sure about this power trade. It's not to say that there aren't individual utility stocks to own that are associated with power, but it is to say, if you're looking at the overall sector and you want to buy the XLU or S&P 500 utilities or our utilities fund, I think that from a cap weighted perspective, these are still regulated utilities. So ROEs are certainly not bad, and they're not as, you know, haven't degraded as much as the operating margins we've seen in healthcare and consumer staples, but they're still not positive. So I think that despite the AI, you know, advantage or tailwind, I think that that's been fully priced. And I think that, you know, again, I don't believe that this defensive rotation is going to be persistent through the course of the year. So I think utilities are better to sell. Healthcare is a different story in the sense that it's down so much it can bounce. The problem with healthcare is that, again, unless you think that I think the market is going down over the next 6 months, 12 months, your odds are not good because operating margins peaked back in the 90s, the late 90s, but the 90s nonetheless. And I don't see any catalyst for an improvement in trend. So with a secular downtrend in fundamentals, you run the risk of, even with sort of a dead cat bounce, this being a value trap in an up market.
Okay, that is so fascinating. I think we'll have to leave it there, but you've just created so many new avenues for us to look at to get away from a very serious conversation around tariffs, but just taking a look at the math that fits with many of the other narratives that maybe aren't getting enough air. Denise, Chisholm, thank you very much for joining us.
Great to be here.
Great to see you. All the best. Have a good